In Chapter 14, we will cover assessing control risks and designing tests of controls and substantive tests of transactions for each of the classes of transactions in the sales and collection cycle. At the end of Chapter 14, you should be able to do the following. You should be able to identify the accounts and the classes of transactions in the sales and collection cycle. Describe the business functions and the related documents and records in the sales and collection cycle. Understand internal control and design and perform tests of controls and substantive tests of transactions for sales. Apply the methodology for controls over sales transactions to controls over sales returns and allowances. You should also be able to understand internal control and design and perform tests of controls and substantive tests of transactions for cash receipts. Apply the methodology for controls over the sales and collection cycle to controls related to uncollectible accounts receivable. And lastly, be able to understand the effect of tests of controls and substantive tests of transactions on substantive tests of details of balances. Let us begin by identifying the accounts and the classes of transactions in the sales and collection cycle. There are 5 classes of transactions in the sales and collection cycle. They are sales, cash receipts, sales returns and allowances, write-off of uncollectible accounts, and the estimate of bad debt expense. In here, we have an illustration of the way accounting information flows through the various accounts in the sales and collection cycle. This figure shows the 5 classes of transactions in the sales and collection cycle as mentioned in the previous slide. It also shows that with the exception of cash sales, every transaction and amount is ultimately included in one of 2 balance sheet accounts, the accounts receivable or the allowance for uncollectible accounts. You can find figure 14-1 on page 448 of your textbook. Moving on, we will next discuss the business functions and the related documents and records in the sales and collection cycle. There are 8 business functions within the sales and collection cycle. They are processing customer orders, granting credit, shipping goods, billing customers and recording sales, processing and recording cash receipts, processing and recording sales returns and allowances, writing off uncollectible accounts receivable, and lastly, providing for bad debts. Table 14-1 shows the 8 business functions for the sales and collection cycle, which is shown on the 3rd column of the table. They occur in every business in the recording of the 5 classes of transactions in the sales and collection cycle. Under business functions, observe that the first 4 processes are for recording sales, while every other class of transactions includes only one business function. In the 4th column of the table is the typical documents and records for each function. Before auditors can assess control risks and design tests of controls and substantive tests of transactions, Auditors need to understand the business function and documents and records in a business before they could actually figure out the appropriate and relative procedures to do during the audit. You can find Table 14-1 on page 448 of your textbook. In the next slides, we will cover internal control, design and perform tests of controls, as well as substantive tests of transactions for sales. The methodology for this process is shown in Figure 14-2, which will be on the next slide. To gain an understanding, the auditor can use the client's flowchart or other documentation and perform a walkthrough test. An example of a flowchart is shown in Figure 14-3 on page 454 of your textbook. There are 4 steps to the Assess, Plan, Control Risk process. These are to determine a framework for assessing control risks, which is provided by the transaction-related audit objectives. Identify key internal controls and deficiencies for sales. Associate the key internal controls and deficiencies with the audit objectives, and assess control risks for each objective by evaluating controls and deficiencies. And here we have an illustration of the methodology for designing tests of controls and substantive tests of transactions for sales. The content of the figure was introduced and explained in Chapter 13. The discussions will be organized around this illustration and applies to sales and cash receipts using Hillsburg Hardware Company as an example company. You can find Figure 14-2 on page 453 of your textbook. The key control activities for sales includes adequate separation of duties, which is the proper separation of duties that helps to prevent misstatements due to both errors and fraud. The auditor is concerned about proper authorization at 3 points, which are: credit must be properly authorized before a sales takes place, goods should be shipped only after proper authorization, and prices, including basic terms, freight, and discounts, must be authorized. Adequate documents and records must exist before most of the transaction-related assertions can be met. These records may be in paper or electronic form. Pre-numbered documents helps prevent both the failure to bill customers and to prevent duplicate billings and recordings. Monthly statements is a useful control because it encourages customers to respond if their balance is incorrect. Internal verification process can be manual or computerized. After key controls and deficiencies are identified, the auditors assess control risks and then determine the extent of test of controls, often using a matrix format similar to Figure 12-3 on page 373 of your textbook. An example illustration of tests of controls for sales are shown in Table 14-2 on page 457 of your textbook. Substantive tests are designed for each transaction-related audit objective. For the occurrence of recorded sales, there are 3 types of possible misstatements that the auditor may be concerned. These are sales included in the journals for which no shipment was made, sales recorded more than once, and shipments made to non-existent customers and recorded as sales. For the completeness objective that existing sales transactions are recorded, this is less likely to be tested because the risk of overstatement of sales is more likely than understatement. Auditors need to understand the difference between tracing from a source document to the journals and vouching from the journals back to the source document. The direction of the test fulfills different objectives. For tracing, the auditor does testing from the source document to the journal to test for omitted transaction, basically fulfilling the completeness objective for the audit. For vouching, the auditor does testing from the journals back to the source document to test for non-existent transactions, and this meets the occurrence objective for the audit. Figure 14-4 illustrates the directions of tests mentioned on the previous slide. For example, if the auditor is concerned about the occurrence objective but does testing in the wrong direction from shipping documents to the journals, a serious audit deficiency may exist. In testing for the other four transaction-related audit objectives, the direction of test is usually not relevant. For example, the accuracy of sales transactions can be examined by testing from a duplicate sales invoice to a shipping document or going vice versa. You can find figure 14-4 on page 460 of your textbook. The accurate recording of sales transaction concerns shipping the amount of goods ordered, accurately billing for the amount of goods shipped, and accurately recording the amount billed in the accounting records. Other key controls of auditor concerns includes sales transactions are correctly included in the master file and are correctly summarized. Recorded sales are correctly classified. And lastly, sales are recorded on the correct dates. The following is a summary of methodology for sales as previously discussed and shown in Table 14-2 on page 457 of your textbook. This includes transaction-related audit objectives, key existing controls, tests of controls, deficiencies, and substantive tests. Properly designed and formatted audit programs eliminate duplicate procedures. All procedures on any one document are completed at the same time, and it enables the most effective order in which to perform procedures. Moving on, we will now discuss the methodology for controls over sales transactions to controls over sales returns and allowances. Transaction-related audit objectives are essentially the same for credit memos as those for processing sales, with two notable differences. First is materiality. Sales returns and allowances are often so immaterial that auditors can ignore them. The second is emphasis on the occurrence objective. The auditors usually emphasize testing recorded transactions to uncover any theft of cash in the collection of accounts receivable that was covered up by fictitious sales returns or allowances. We will now cover internal control and designing and performing tests of controls and substantive tests of transactions for cash receipts. Auditors use the same methodology for tests of controls and substantive tests of transactions for cash receipts as they use for sales, such as determining key internal controls for each audit objective, designing tests of controls for each control used to support or reduce control risks, and lastly, designing substantive tests of transaction to test for monetary misstatement for each objective. A control risk matrix for cash receipts is presented in Figure 14-5 on page 466 of your textbook. An illustration of key internal controls and common tests of controls are shown in Table 14-3 on page 465 of your textbook. In addition, an example of an audit program is shown in Figure 14-6 on page 467 of your textbook. It is difficult to detect theft of cash when it occurs before the cash is recorded. To determine whether cash received was recorded, pre-numbered remittance advices and pre-list of cash receipts are usually tested against journals, but this is effective only if the pre-list was prepared when the receipt was received. To test for the proof of cash receipts, total cash receipts recorded in the journal for a specific period is compared with the amount of cash deposited in the bank during the same period. Lapping is an activity or an action wherein an individual postpones entries for cash receipts to conceal an existing cash shortage. This can be easily prevented by adequate separation of duties. We will now discuss the methodology for controls over the sales and collection cycle, two controls related to uncollectible accounts receivable. Similar to sales returns and allowances, the auditor's concern in the write-off of uncollectible accounts is the possibility that write-offs are used to cover up embezzlement of cash receipts. The auditor is also concerned with the balance-related objective of the realizable value of the net accounts receivable. Two controls that address this issue are the preparation of a periodic aged accounts receivable trial balance for review and follow-up by appropriate management personnel, as well as a policy of writing off uncollectible accounts when they are no longer likely to be collected. Moving on, we will cover the effect of tests of controls and substantive tests of transactions on substantive tests of details of balances. The results of the test of controls and substantive test of transactions have a significant effect on the remainder of the audit. If the test results are unsatisfactory, it will be necessary to do additional substantive testing. The most significant effect of the results of the test of controls and substantive tests of transactions in the sales and collection cycle is on the confirmation process. The type of confirmation, the size of the samples, and the timing are all affected. The major accounts in the sales and collection cycle and the types of tests are illustrated in Figure 14-7 on page 469 of your textbook. In here, we have an illustration of the major accounts in the sales and collection cycle and the types of audit tests used to audit these accounts. We covered this in the previous discussions. Figure 14-7 provides a summary of the audit methodology applied to the sales and collection cycle. The cycle is audited using the test of controls, substantive tests of transactions, and substantive analytical procedures. Ending balances for sales is usually audited using substantive analytical procedures and tests of details of balances. Sufficient appropriate evidence is acquired through the application of tests of controls, substantive tests of transactions, substantive analytical procedures, and tests of details of balances. You can find Figure 14-7 on page 469 of your textbook. This is the end of the discussion for Chapter 14. We covered the audit methodology applied for each of the 5 classes of transactions in the sales and collection cycle, including sales, cash receipts, sales returns and allowances, write-off of uncollectible accounts receivable, and bad debt expense. Please complete the required evaluation method for Chapter 14 as it will be part of your final grade. Use Blackboard to complete the requirements. You have reached the end of the course presentation for Chapter 14. Please access the video for Chapter 15 for the next presentation of the course.